Wall Street spent 3 weeks writing research notes calling SpaceX a generational infrastructure play. One analyst literally used the phrase, paving the superhighway to the stars, and then a single Starship abort erased 14.7% of implied value in days. Here is the number that should stop you cold. SpaceX was trading on secondary markets at roughly 185 times forward EBITDA before this happened. Not revenue. EBITDA. So the real question is not whether Starship can eventually reach orbit. The question is whether you actually understand what you own when you buy a private company, at that multiple through a platform that cannot guarantee your exit. Let's establish the foundation, because this is where most retail analysis breaks down. Before the abort, SpaceX's implied valuation in secondary markets had climbed to approximately $210 billion. That number did not emerge from a discounted cash flow model anchored to current operations. It emerged from a narrative stack. And it's worth dissecting each layer, because this is how you learn to spot the same pattern in the next private company that captures the market's attention. Layer 1 is Starlink, the only part of SpaceX that looks like a conventional business. Starlink had crossed roughly 4.6 million active subscribers globally by mid-2026, generating estimated annualized revenue somewhere between $7 and $9 billion, depending on which secondary data source you trust. That business, standalone, is genuinely valuable. If you applied a 12 times revenue multiple, aggressive but not insane for a high-growth satellite broadband provider with real moats, you get somewhere between $84 and $108 billion. That is the real floor of this company. Layer 2 is the launch business, which is operationally profitable but capital-intensive and cyclical. Falcon 9 has had an extraordinary reliability record. 97 successful missions out of 97 attempts over the last 18 months. That track record is genuinely impressive. But launch contracts are lumpy, NASA and DoD relationships carry political risk, and reusability economics, while compelling, are not yet the margin story that promotional materials suggest. Layer 3, and this is where the $210 billion number lives, is Starship. Fully reusable, potentially dropping launch costs by 90%, enabling the Mars colonization thesis, powering point-to-point Earth travel. This layer is not a business yet. It is an option, and options have a habit of repricing violently when the underlying event gets delayed. The abort did not kill SpaceX. It repriced the option. Understanding that distinction is the only actionable insight that matters from this week's move. Here is what the bullish research notes did not explain clearly. When you buy SpaceX exposure through a secondary market platform, and in 2026, several of these platforms are actively marketing private equity access to mass affluent retail investors, you are not buying a share in the same sense that you buy Apple on a public exchange. You are buying a contractual interest that is subject to transfer restrictions, right of first refusal clauses that SpaceX itself holds, valuation marks that are set by the platform rather than by continuous price discovery, and an exit window that is entirely contingent on either an IPO, a tender offer, or finding another buyer who wants in. This matters enormously when you consider what a 14.7% drawdown means in that context. On a public exchange, 14.7% is painful but liquid. You can exit at market price within milliseconds. In private secondary markets, 14.7% is the bid-ask spread collapsing. The buyers who were at 185 times EBITDA are now at 155 times, and there are fewer of them. You are not selling into a market. You are negotiating with a market that now has more information about operational risk and fewer reasons to pay your entry price. This is not a hypothetical risk. During the 2022 private market correction, secondary market platforms for late-stage unicorns saw discounts of 40 to 60% below the last primary round valuation. The investors who got hurt were not institutions. Institutions had negotiated downside protection provisions, liquidation preferences, and anti-dilution clauses. Retail investors who came in through democratized access platforms held common interests with none of that structural protection. And this is not financial advice. But knowing the difference between owning equity and owning an illiquid interest in equity is not optional if you are putting real capital into private markets. That knowledge is table stakes The Starship abort did not create this risk. It made the risk visible. So let's separate what this event actually tells you from the noise that will dominate the next 2 weeks of social media coverage. The noise is, SpaceX is failing, Musk is distracted, the space economy is overhyped, get out of everything. That is not a serious read. The signal is more nuanced and more useful. Signal 1. Operational setbacks reprice optionality, not core business value. Starlink's 4.6 million subscribers did not disappear because Starship aborted. The Falcon 9 launch manifest did not evaporate. What evaporated was the premium the market was willing to pay for future capabilities that have not yet been demonstrated at scale. That premium was always the most speculative component of the valuation, and it getting compressed is a correction toward rationality, not a collapse of the underlying thesis. Signal 2. The timing of this drawdown is not coincidental. We are in a macro environment in mid-2026 where risk-off sentiment has been building. Credit spreads have widened. The Fed's terminal rate projection has been revised upward twice this year, and growth assets have been under pressure across the board. Private market valuations are always the last to reflect macro stress because they are not marked continuously. When stress finally hits, it hits in clusters. This week's SpaceX repricing is partly about Starship and partly about the broader repricing of long-duration speculative assets that has been overdue. Signal 3, and this is the one worth writing down. The companies that survive private market corrections are the ones with a profitable core business that can self-fund while the narrative layer gets rebuilt. Starlink is that profitable core for SpaceX. The question for any private company you are evaluating is always the same. Strip out the option value, strip out the narrative premium, and ask what the business is worth today if the breakthrough never comes. If that number still justifies the entry price, you have a defensible position. If that number is a fraction of what you paid, you own a lottery ticket. Both can be legitimate choices. The problem is when investors don't know which one they hold. We started with a 14.7% drawdown and a question about whether private valuations hold under pressure. The answer is, they hold at the core and collapse at the edge, specifically at the speculative premium layer that most retail buyers paid for. The real risk was never the abort. It was not knowing which part of a $210 billion number you actually owned. Next question worth asking. When SpaceX eventually files for an IPO, what will the public market multiple look like compared to where secondary buyers got in? That math is uncomfortable, and we are going to run it. Subscribe so you don't miss that one.